Hey guys, I've been helping people evaluate businesses, typically FedEx routes, for over a decade now, and someone recently noticed that one of the listings for the FedEx routes had gone off market and says that it's no longer approved for financing. It's going to be cash buyer only. And if that was a problem with the bank, maybe something with the deal itself. And I think that there's a couple of things that are important to unpack here. One is that a lot of times when we see these things fall through with financing, it's not necessarily because of the business. So for example, if you go to get a house and try to get a mortgage, the bank doesn't finance it. Maybe they found out that there's extensive termite damage or whatever, right? That's why it's not getting financed. In the FedEx world, some of these banks will say that they can get things financed. The broker, there's a lot of newbie brokers out there, doesn't know all the banks out there. They say, okay, sure, let's move forward. They get 90% of the way through, and then the bank says, oh, this contract looks scary. Oh, we don't really understand this. Oh, what have we gotten ourselves into? And then they drop the ball. That happens with a lot of the banks out there that say that they can get these things done, or they financed a deal last year one time. They don't have a very solid track record with financing a lot of these deals, and consistently. And so when we see these things fall through, it doesn't necessarily mean that the business is bad. It sometimes means that the bank selection was maybe not the best, right? So that's one thing. Sometimes, obviously, banks, as they're going through their evaluation process, they're going to notice something that makes a deal fall through. That can happen a lot of times. Most of the banks, and there's a lot of banks out there that can try to finance these things, again, hit or miss, right? Whenever we see that happen, it's not that they're going to find a lot of the issues that really plague this industry. Whenever we see problems, it's not like the business doesn't make any money. That's kind of like a problem with a lot of other businesses for sale. It's not necessarily so much with a lot of the FedEx routes. The money's typically there. It's other little things that start to make them nervous, or they can't quite figure out what is good contractual performance, what are good delivery standards. They don't know that, right? You have to be a contractor to really understand this business to know the answers to that. So the point is like whenever a bank rejects it, yes, it could be for some very valid reasons. A lot of times it's not for valid reasons. Like they used to reject a lot of these applications because, the contract was only 2 years or 1 year or 3 years, whatever. And so it's changed throughout all the years, that we've purchased these routes and everything. But the point is that banks can freak out for a lot of different reasons. Sometimes they're good reasons. A lot of times they're bad reasons. The other thing is that whenever we see a business that is SBA pre-approved, like there's this sort of aura like, oh, well, this one's better than the one that's not pre-approved. Like they've already evaluated this. This thing has already gone through the pre-approval process. This one's good. And that doesn't work either because, again, the banks don't know how to see all of the sorts of issues that can and actually do creep up as problems in this particular industry, right? So I would be very, very cautious against letting the SBA sort of give you the warm fuzzies of, hey, it's approved, so it's a safer investment. That's not the case. I've seen tons of incredible routes for sale that will not get SBA pre-approved. Maybe the owner lied on his tax returns, or his tax returns are just so like skewed, or so many write-offs or whatever that they're not quite legitimate, like they can't quite do it. Lots and lots of different reasons, both valid and sort of invalid. But the point is like there are some great routes that will not get financed. There are some terrible routes that have been financed. A lot of times those things default too. And then the banks get scared. They say, oh, we don't like this business. Oh, there's these defaults and, we're going to go back to our typical franchises and coffee shops. And like, that's probably a bad idea too, because this is a fantastic business to loan on a lot of times. But you do have to have some very deep niche expertise in this to be able to evaluate that. And of course, also, if the SBA was, sort of giving us the warm fuzzies again to say whether you could buy this business or not because it's pre-approved, like no one would bother with any sort of evaluation or due diligence. We would just say, well, I'm just going to not bother with that. I'll just buy whatever business is SBA pre-approved and then I'm safe. Well, look at all the SBA default rates for franchises and stuff. Like it doesn't mean that it's safe. So that's a super important part. A lot of people try to think that it is. It's just simply not. And you will walk away from really great deals if you get nervous from a deal that does fall through from bank finance. It could just be to the bank, could be due to the tax returns, could be due to a lot of things that may or may not be valid for your particular situation. So a lot of times when we think about whether a business can be financed or not, it's not about whether it's possible, it's about whether it's probable. So for example, a bank's going to say, hey, we finance these things all the time, which might mean like once every year or once every 2 years or something like that. They take your application fee and then they get into it and they say, we don't like this one, or we're going to value this thing so unbelievably low that no reasonable seller is going to take this offer. And again, you lose your application fee, you lose a bunch of time, pisses off brokers, pisses off the sellers, everybody's unhappy. You have to be wary of situations, and this also really occurs in your evaluation, is that what is possible does not necessarily matter. It's what's probable. Like, you could possibly win the lottery. Like, we're not going to run out and buy a bunch of lottery tickets tomorrow, you know? So like, the point is like, when you look at these banks, you're not really trying to find out, oh, have you guys ever done this before? Granted, obviously that's a good start, but secondly, how often has it happened? My experience is that there are a few, like maybe 2, 3, something like that, banks that have consistently and repeatedly finance these businesses. And granted, yes, there are other banks out there that can get this thing done. I'm talking about the banks that have repeatedly done this for years at this point. When you have that sort of track record, what I've noticed is that if you have about 20% down for whatever business that you're looking at in terms of the down payment, 20% cash down, that gets the ball rolling. Yes, it could be done with 10%. Oh, yeah, I heard about a situation where they got it done with 5%. Yes, those things happen. But again, back to the probabilities. Is it probable that you're going to get financed with only 5% down? No. Let's look at 20%. That gets the ball rolling. And then at that point, if the bank that you're looking at or working with can't get things done, there's another bank that probably can. I do work with a couple of the banks that, can get those things financed. If you want to reach out, definitely we can get you in touch with them and see if there's a good match there. But anyway, the point is, there's, again, more than just a few banks out there that can get this thing done. We want to talk about the probabilities of them being able to get it done and go from there. So anyway, hopefully this helps out a little bit with thinking about the SBA, the financing, the pre-approvals, and line haul versus P&D and all that stuff. And hopefully this helps out. All right, guys, have a great day. Bye.